Hello and welcome to RVA Wealth Management's second quarter 2023 market update. I'm David Koren, and with me is Mike Smith, and we're here today to talk about where we are and what we're thinking about in terms of the future this year with the markets. This is your team, RVA Wealth Management. We have one new addition. Mary Beth Cooper is another client service specialist that we've added. She's actually based in St. Louis and works remote on a part-time basis for us right now, but she's been a nice addition to the team. We're happy to have her. And nobody's left, so we're still the same happy family here for you when you come in to visit. So this year so far, we've had a pretty decent start overall. We did get a little rally primarily, we believe, in the 7 stocks out there that really represent the AI category. Artificial intelligence is the next new thing, the next big thing, really, I believe, in the markets. And we've seen that in terms of some of the response of the market so far this year. The rest of the market is relatively flat to start the year. So if you, outside of those few stocks, we haven't seen much of a big move in the market since being driven by those key stocks, and Mike will talk about that a little more as we go through. We are really actually pretty cautious in our outlook, which was reflected in our model changes that we made last month. We do not know when the Fed will change course on their rate actions. So at this point, they continue to fight inflation. Their last meeting, they raised another quarter point. We're getting up into that 5% rate area now for the Fed, and it could go higher. We got a pretty decent number in terms of jobs just this week, so we are concerned that the Fed may continue to raise rates. They are trying to slow down the M2 supply out there, and they're doing it in several ways, and one of them is obviously by raising rates. The other one is by reducing liquidity in the markets in general through some of their bond actions. So the Fed is taking every action, and they have reduced the money supply out there. This is, again, reducing liquidity in the market. It is poisoning the market that will take effect at usually 6 months to a year after the actual action. So they're still taking action. So what's going to happen, we don't know. There are a lot of geopolitical issues out there that are causing headwinds for the market. And obviously, this inflation and these higher interest rates are also a headwind for the market. The debt ceiling debate seems to have frozen the market temporarily. So we really don't know what to expect from a direction standpoint until that clears up. There was a deal struck this past weekend, so we do think that it will be freed up and that we will get a deal on the debt ceiling. But what we can tell from the deal is that, again, that is a way for the government to reduce liquidity again in the market. So they're not spending as much, they're reducing liquidity. All of this should lead to some real headwinds for the economy. And that's what we're expecting this year. So we think that we will see probably a dip at some point this year as a recession takes hold. May not happen this year, but we do believe it's coming. And once it does, it will behoove the Fed to probably take action at some point. If they do reduce rates and if they do it too soon, we could see inflation come back. So they're in a very difficult position. I don't envy the members of the Fed at this particular point in time trying to figure out how to handle this inflation and keep the economy going. The economy looks pretty good at this point, so we'll see how that plays out this year. So let's talk a little bit about the market. I'm going to let Mike give you some insight in terms of where we see the S&P at the moment.
So just a little refresher, the market peaked early 2022 and hit at all-time highs, just below 4,800 on the S&P index. Had the big sell-off, of course, last year, and it has rallied a bit this year, so we're now 13% off the all-time highs. But what David was alluding to earlier was the 6-7 tech giants have accounted for just about all the gains. And the S&P 500 is a market-weighted cap index. If you were to look at the equal-weighted S&P index, it's basically flat for the year. The Dow Jones is flat for the year. NASDAQ is having a strong year after getting really clobbered last year, once again led by the tech giant stocks like NVIDIA up over 100% this year, whereas most stocks are still sort of treading water. The forward price earnings multiple on the S&P is a little over 18 times, which historically speaking is a little overvalued in our opinion. So the index is sitting right around 4169 at the end of trading in April 30th. We're recording this in May. It hasn't moved a whole lot off those levels right now. So economic growth, the trend line for our GDP growth has been right around 2% over the last 20 years or so. We're trending a little bit below that at this point, but we haven't seen the recession really that many have called for. And that's the big debate. Do we get a soft landing? Do we have a hard recession at some point? The interesting thing is the composition of GDP. The consumer is about 70% of GDP, and the consumer has been pretty resilient this year. They have excess savings coming out of COVID, though that's starting to be spent down. But the most important thing has really been the job numbers. There's still shortages out there, and you have unemployment rates below 4%. So as people are working and spending money and also getting wage increases, the economy has held up very nicely.
I think, Mike, when we talk about GDP and what's going to happen going forward, I mean, the purpose of the Fed's action in controlling inflation and raising rates and constricting the money supply, those two actions, long term, the desire is really to cause a slowdown in the economy, whether that's a soft landing or not. We don't know at this point, but it is likely that's what we're going to see. And we've also already begun to see profits contract a little bit. So it's not going to be a surprise if GDP is not stellar this year.
A lot of the talk recently has been about the regional banks, and of course the failure of Silicon Valley Bank made a lot of headlines, and there were others certainly involved. So the big question became, what's the strength of the U.S. banking system? And the slide on the left that J.P. Morgan provides is looking at the U.S. Bank Tier 1 capital ratio, which looks at the liabilities on the books, the loans outstanding versus their assets, stocks, cash reserves. And the U.S. banking system is actually in great shape right now, really strong. Really coming out of the great financial crisis, they were forced to increase their reserves, went through very rigorous tests, especially the larger, too big to fail banks. So banking is strong right now. We do expect to see some consolidation. These smaller regional banks, there's probably way too many out there right now. They're losing assets as they can't compete with the money market rates, and they have an inventory of long-dated bonds that have gone down in value. So there's a lot of challenges there, and it has a big impact on the economy. On the right, it's looking at the lending standards that have tightened considerably, really looking back to the second quarter last year. These regional banks now are more concerned about the strength of the balance sheet than profits right now, and they are really going to be tightening up. And this affects, they do a lot of construction loans and small business, medium-sized business loans out there on regional banks. So that will have an effect. It'll take probably a little time to pass through the system, but this is definitely going to slow the economy down.
Yeah, and I think when we look back at what happened with the banks recently, we had several that did go under, regional banks. Most of that, it was due to a combination of events, but it really was boiled down to poor management. But it had to do with the duration risk management, because anytime when interest rates go up as rapidly as they have, and you're holding a lot of long bonds, you are going to see a dramatic drop in the valuation of those bonds. And so the banks saw that happen. They had a lot of long duration bonds in their portfolios, saw those values drop dramatically. They weren't in a position to sell them. And so when they saw the massive number of withdrawals occur, because I think it's been a record now, I just read a headline today that there's a record number of withdrawals coming out of the banks this year, going into money market accounts that are paying higher rates. When those two things combined, it really created a problem for the banks, and hence they're tightening up. They're being very careful. They're watching their balance sheets. They're very concerned. They don't want to fail. And so we're seeing that. And we're not talking here about any concerns with the big banks. This is really the smaller regional banks that have had the problems.
The big story last year and continues to be the Fed raising interest rates. They brought the markets down last year, both stocks and bonds off sharply as interest rates were increased rapidly, and they went up more than the market had bet. This is a chart showing what the federal funds rate expectations are. And the blue is the expectations or the dot plot that the Fed publishes during their meetings, year-end estimates. So we're right around 5% right now. And if you look at the chart, it's trending down. The Fed is anticipating they can cut rates at 2024 into 2025. But the green line is the market expectation. So part of the reason the market's held up well is the market has bet that not only is the Fed going to stop raising rates, they actually anticipate by the end of this year the Fed will cut. So there's a big discrepancy there. Our feeling is it's going to be very difficult to cut the remainder of this year. When you have unemployment where it is, stock markets still at fairly high levels, profits are okay, inflation is down but not where the Fed is targeting. The Fed would love to see inflation back around 2%, not even close right now. So there's not a big incentive for the Fed to cut. So we'll have to see. And if the market wakes up and starts to realize the Fed cuts are further down the road, does this market pull back or not?
Yeah, I mean, I'm really just hoping, Mike, at this point that the Fed pauses, because they haven't paused yet. What I mean by pause is they don't take a rate increase. So, no signs yet that they are going to reduce rates. It would take a pretty big hit to the economy for them, I think, to reduce rates, especially this year. So I think the market expectations may be off a little bit, and that could mean a pullback in the markets when the markets realize, oops, we missed this one.
That's right. They raised during their March and May meetings, but there's another meeting coming up, and now there's more than a 50% probability that they have one more raise. So we'll have to watch that. Another big story has been real estate, certainly. Housing inventories and single-family housing starts are still below historic averages. The market after the 08-09 crisis, we underbuilt for years. Loans are tougher to come by, and we've chronically underbuilt in this country, especially medium and affordable housing. And now we're coming into a point where both millennials are really ready to form households right now. They want that first home. And to make this problem a little worse, we're seeing people that have locked in very attractive mortgage rates over the last few years. They're not going anywhere. They're not moving unless they absolutely have to. They don't want to write another mortgage at much higher rates. And so that takes a lot of inventory off the market again. So the only place we're really trending above historical starts are multifamily or apartments. We're seeing a lot of those being built, certainly in the Richmond area. They're going up everywhere. That's above trend, but there's still a huge shortage of housing here. So we had a slight pullback last year in housing prices, but markets are starting to firm up again.
Yeah, Mike, housing has a lot to do with the market. I mean, and the economy. When you think about it, the more housing starts we have, the more stuff needs to be bought to put into those new houses, and that's just a real impetus for the market. It's a real stimulus for the market when we see a lot of good housing starts. And what's interesting is during the first half of this year, one of the other areas that did well, other than the AI companies, were the builders. Because I think finally the market realized, hey, wait a minute, even with these higher interest rates, the builders the demand's still there for the housing because, again, we've underbuilt for so long.
That's right. So we've just come out of a very long cycle of U.S. equity outperformance versus international markets. One of the longest stretches we've seen over 14 years where the U.S. clearly outperformed international markets, driven by the U.S. tech names that really outperformed the last few years, and Europe doesn't have companies to compete like that. The trend finally broke a slight outperformance over the last year or so in international markets. We'll see if that holds up now because now the U.S. growth stocks once again have taken off recently. But There is some value out there internationally to look at. And we're still personally overweight U.S. stocks here relative to international, but we have been kind of starting to dip our toes in some international value markets. And looking at how the global earning estimates are trending, the U.S. and China and the emerging markets, the estimates are saying we've peaked, at least for the time being, and earnings estimates are expected to come down over the next few quarters. Europe on the left in green is still trending up, albeit from a very low base, but Europe, the companies are performing well. And on the right-hand side, you're looking at the valuations. So Europe is trending well below their 25-year average for their price-to-earnings multiples. U.S. is a little bit above, basically slightly below, but not cheap, certainly. And China's sort of trading in line right now. So Europe looks like it's a pretty decent value here.
So that concludes our little market update for everyone. I hope that this was helpful. If you have questions, please send us an email. Let us know what those questions are, or give us a call. Be happy to answer or talk to you if you do have questions about the current market situation out there. So thanks, everyone. We appreciate your confidence in us and your partnership in terms of working with us. And see you at our next meeting.